Good morning, Monday, November 18th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If I have something to report or say intra-week, you'll find it either on X under @Herb W. Morgan or on LinkedIn, just Herb Morgan. This presentation has been prepared by Cantor Fitzgerald Investment Advisors for use by investors and financial advisors, but each are expected to make their own investment decisions. Nothing contained in the presentation is investment advice, tax advice, or recommendation for the purchase or sale of any security, strictly for informational purposes. The views expressed herein are mine and mine alone. They may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, after the big post-election rally, the surge in risk assets, the euphoria on the thought of less regulation and higher profits and more growth, etc., that spiked the market higher. As you remember last week, I talked about the RSI of the S&P just a little ahead of itself. And true to form, the market did what it did. It said it's ahead of itself, and it was, and it gave back a little bit. S&P down about 2%. Mid and small cap stocks down more. Emerging market stocks really down about 4.5%. But the year-to-date numbers are just excellent across the board. It's been a great year for equities. It's been a great year to own equities. And it's been an okay year to own bonds, particularly if you were in high yield, which correlates with equities. You can see high yield up 7.5% for the year. But interest rates, ever since the Fed started cutting, interest rates have been going higher, significantly higher. And the 10-year U.S. Treasury yields approaching 4.5%. Why? If the Fed is cutting, are rates going higher? Because the market sees inflationary pressure. If you've been following this report, when the Fed started cutting in September, I said, don't do it. I think it's too soon. I think it's too much, and inflation is not yet contained. One of the biggest reasons inflation is not yet contained is massive fiscal deficits. 6.5%, 7% fiscal deficits, no doubt, create inflationary pressure in the economy. Now, this election, to a certain degree, may turn out to have been about the size and scope of these fiscal deficits. It's very much unknown. On the one hand, President Trump has controlled both houses of Congress. His party has controlled both houses of Congress. So they could deficit spend their way to prosperity. That's one theory, and a lot of people in the market believe that's what they will do. Still others, and the president-elect's own words and the words of his proxies, people like Howard Lutnick from Cantor Fitzgerald, Elon Musk, Vivek Ramaswamy, are talking about no radical change to the G in the C plus I plus G calculation for GDP, and a reduction of those deficits. That, no doubt, will help inflationary pressures and bring inflation under control if it's allowed to be implemented. Court challenges, Congress, you name it. This is not going to be an easy road. Let's talk about the data we got last week. Let's start with small business optimism. The index rose from 91.5 to 93.7 for September. That was above estimate. And it looks like we're breaking out of this bottom. We've kind of been 2 years down here, more than 2 years, this bottom around 90. And if we can get above 95 in the next couple of months, it seems like people are getting a little more optimistic. This was all taken, by the way, before the election. Weekly claims for unemployment, that's initial jobless claims, remain very, very low, 217,000. The estimate was for 220. Continuing claims remain at that 1.8 level, 1.9 level. So healthy labor market, strong demand, aggregate demand in the economy. We also got a surprise print, a surge in New York State manufacturing. In October, came in at 31.2, November was 31.2, up from a minus 11.9 in October and way ahead of the estimate for 0. New orders surged higher, minus 10 to 28. Shipments also surged higher, minus 3 to 32. Just a big, big change in that. We've been in this doldrums of manufacturing. Is this a one-off? Wait and see. But it was certainly welcome news for the manufacturing. We know the service sector has been very strong. Industrial production and capacity utilization came in. Now, I've been talking, about all the inflationary pressures out there. One of the biggest contributors I just mentioned is the fiscal debt and deficit situation. But capacity utilization is also a good indicator of the directionality of inflation, because as capacity utilization gets high, above 80, really usually correlates strongly with future inflation. It has been trending down, but partly because manufacturing has been trending down. Industrial production fell 0.3%. And then capacity utilization fell to 77.1. So that's a little bit of an inflationary relief or disinflation. Retail sales in October gained 0.4, taking out autos and gas up 0.1. So retail sales remain strong. The consumer remains strong because employment remains strong. Then we got the readings on CPI and PPI last week. And this is what I've been talking about for a while. Okay, CPI in October up 0.2, in line with expectations, fourth straight month, 2.6 a year from year over year. Remember, the Fed has said they define price stability. They self-define price stability. Price stability was what was statutorily given to the Fed by the Congress. They defined it as 2% inflation. I would define it as stable, as 0, maybe 1%. But they've chosen 2, and that's fine. But they're well above 2 at 2.6 as measured by the CPI. You can also look at the core CPI, which is higher still. That's the red line. Core backs out the food and energy. The core is 3.3% from a year ago. But they don't use the CPI. They use something called core PCE. So, okay, core PCE is also stubbornly high. We didn't get that last week. We got PPI instead. October PPI gained 0.2, right along with estimates. That's up 2.4 from a year ago. PPI stands for Producer Price Index, obviously, and that is up 3.1% year to date. And as you can see here, it's kind of been accelerating for 8 or 9 months. Not anything we really want to see happen. But when you look through the PPI at some of the data, there are a number of components that are in that data that feed into and contribute to the makeup of the PCE price index. And that is the gauge the Fed uses to determine whether or not it's meeting its statutory mandate of price stability. Two such items, airfares and portfolio management fees, saw very, very strong gains in October, suggesting that the October PCE index is likely to come in hotter than expected. All of that then causes the market to rethink their expectations about interest rate cuts that have been priced into the market. And I'm going to come back to that in just one minute. October import prices up 0.3% and up 0.8% year over year. So not too bad there. So we're feeling pretty good about that one. Here's what I said about getting back to Fed rate cuts. So this is a little bit confusing. But on September 1st, so right before the Fed started cutting, the view was that by the November 7th meeting, the one we just had right after the election, we would be looking at let's call it almost 3 cuts. So 75 basis points by September 1st, by November 7th. And what did we get? Well, we got 50, and then we got 25 next week. So we did get that 75. But if you go down here, these are all meeting dates, right? If you look at the last of the year, on September 1st, we were pricing in 9 cuts. So that's 225 basis points, and they were looking at a Fed funds rate of 3%. Then on November 1st, this is before the last meeting, we were pricing in only 5 cuts, a little bit more than half. Now we're pricing in only 3 cuts. So we're talking about a total change in the concept of what's going to happen to interest rates this year. And that's causing some angst in the residential real estate market and other markets for sure, who were delaying and putting off and waiting for rates to come down. Now we did get the 50, obviously, in September. We did get the 25 in November. But I don't think, the next meeting, of course, being December 8th, I'm not 100% sure, because this is as of this morning, it's only 50-50 chance they'll cut 25 basis points. And it looks like 25 by January 29th. My guess is they skip the December 18th cut and give the data time to percolate out, and they may or may not cut on January 29th. So that's a big change. The other thing that's happening, as I reported to you the last couple of weeks, this growing gap between the risk-free earnings yield, or the risk-free U.S. Treasury yield, and the earnings yield of the S&P 500, the inverse of the price-earnings ratio, the earnings-to-price ratio. The earnings of the S&P 500 are a paltry 3.75. Now, earnings are great, earnings are growing, but because the price of stocks has come up so much, particularly these fast-growth, high-growing, Magnificent Seven companies, if you just divide the earnings by the price, you're getting 3.75%. That gives you very, very little room for error. It's part of the reason the market sold off kind of aggressively last week. At the same time, if interest rates were zero, you'd say, well, I'll take stocks. They pay more. But they're not zero, and they're likely to stay higher a little bit longer. So we're almost 4.5% risk-free on the U.S. 10-year Treasury. That's hard to pass up for investors. So for this reason, I still think, even though we got a little correction last week, I still think a bigger correction is more likely than not in the very short term. Moving on to data for this week, we've got National Association of Home Builders Housing Market Sentiment Index coming this morning. Housing starts and permits on Tuesday. Wednesday, nothing. Thursday, as always, weekly jobs claims. Philly Fed survey that coincide with the New York State we just talked about. Home sales for October on the existing side, and then flash readings on Friday, PMIs from S&P Global for manufacturing and services. Manufacturing is getting closer and closer to 50, given that big New York number we had. If we get a Philly number, that's good. Maybe we could get that back to 50. That would be exciting. And of course, the services sector has been very healthy, 55, and then consumer sentiment. Thanks for tuning in, everybody. Don't forget, we're on all the podcast formats, but the best place to catch us is on the YouTube channel, Slaying Bulls and Bears, trying to make the complex and complicated simple and sensical. Thank you, and I will see you again in 1 week.